Hey, what's up, knuckle draggers? Hope everyone had a great weekend. I'm just going to go over a chart here on high. Again, these turbo Ponzi's, they tend to pump parabolic, and then when they collapse, they really go down. So let's have a look at this one. First thing to note on the daily. So daily, 12-hour, 4-hour, this was a raid. So they raided this high right here after a pretty strong move up. So we go from the low to where it peaked. That was 35%, right? So that's a pretty wild move up, and typically you're not going to go in one straight line. There's going to be some pullback or mean reversion once you get up there. So what I was looking for was on the low time frame. I've been watching this for a minute, but the idea was there was a consolidation here, and then when you go into the 15, you could see this candle took the inside or the internal liquidity here before pushing down and then shifting structure right there. So if you kick it back into the 1 hour, you'll note that there's a major imbalance right here. Not major, but it's an obvious one. Now, some people will trade in the 1 hour imbalance alone, but what I like to do is line it up with lower time frame. So I typically look for the middle or the equilibrium within the imbalance to get disrespected or rejected. But if you pop it into the 15, you'll note that there's a tiny imbalance here, but then the major one, the one that stands out, is actually in between this wick and that wick right there. So I was actually trading off this imbalance on the 15-minute. And the best way to set it up is look for an inversion or a change in the state of delivery. So effectively, you're in an uptrend. Here you've created a candle close low. Sometimes the wick will confuse you, but what I'll do is pop it into a line and then just mark out my CSD or change in the state of delivery. So now when you go back into your candle chart, you'll see that they wick into it. So they basically wick just outside of the 15-minute imbalance, and then they ping that CSD, which is this candle close right here, and then that's what gets rejected and pushes down. And you could see from entry, I basically entered at the top of the imbalance just to make sure, like 541 or 542. I think it was 542. But let's say you got in at 542, top of the imbalance, to where we are right now. That's a 10% move down. Now, I'm still probably going to take heavy profits in a moment. And I don't have a large position. It's pretty small because it is a shit coin, right? So what I'm just trying to do is go very, very low size, relative size for what I use, and capitalize on a much larger swing on these, because once they do reject, they tend to move in a exaggerated push down. Now, the one thing I'm sizing up is my dealing range and whether there's a lower imbalance after taking a daily external over here. Typically on a mean reversion, you're looking at your dealing range. So from this wick low to that wick high, you mark out your premium discount range in the range, and you're looking for an imbalance within that range. So I'm aligning the external daily raid with the internal daily imbalance here, and that's typically what I'm targeting in discount to take profits. So I'm expecting within this range one more push down into here, into pretty deep discount, and then somewhere in this pocket over here I'm expecting bids to come in, mainly because when you zoom out onto the 3-day, you can see there was an external raid here, and there's an internal 3-day imbalance above that wick. So this right here, stopping volume just below the main internal imbalance, which is the 3-day, I guess the 3-day draw on liquidity, tells me that this is probably going to form a higher low within the range here, and then push up to take the final rebalance here. And there's another one right there, but I don't think they're going to target that. It's too small. They might, just because it's part of a much larger weekly. So I'm looking to reverse the trade whenever we enter in the daily imbalance here. Now, the other thing I noticed for this one, it seems to be respecting the OTE, or optimal trade entry, which are the fibs between the 618 and the 786 within each dealing range. So if we treat this swing low as the dealing range low to this high, the dealing range high, and we mark out our OTE, I'll just extend it out. You can see that's more or less where it bases, around the 705, between the 705, 786, and then it pushes up. So now if we take a second OTE from this leg of the range, so we use this dealing range low to that dealing range high and drag it out, you can see our daily imbalance sits inside of that OTE. So what I'm anticipating on this next move is one last drive down into this range, and then potentially basing inside this order block right here. So something like this, where it induces longs over here and then swipes down, basically rebalancing this zone right here, and then holding it to push up into the 3-day. And then this is where I'll go short again, down. So that's the high setup. I'm in the short, pretty nicely. I think it's like 250%, but one more push down. Big respect to Duxx in our one of our servers. He actually pointed this one out. He's got an incredible eye for what to look for, and I'm just overlaying some of the things, the nuanced things that I'm looking for before taking the short. But if you got in from the high, the actual liquidity rate, that was the risky entry, and that would have been 13%. So my point here is you don't have to get in on the wick high. You could get in on the I guess safer entry. So that change in the state of delivery ended up being the safer entry. Again, you miss out on maybe 3-4% of the move, but you've confirmed order flow, and at that point you have much lower odds of losing money, so you're protecting capital and you're maximizing your upside when the move goes down. All right guys, have an amazing day.